Hello and welcome. It is Financial Modeling World Cup weekend this weekend, so as usual, I'm trying to figure out what might be coming up. It's a little vague. The question guide we got for this weekend is a little vague, so speed it up. Obviously, we never really know about that. We know that there's one question about launching a new game console. I have a vague recollection that at the start of my consulting training many years ago, we did a case session on analyzing the video game market. I just have a memory of like one of the slightly more senior junior people, pretending to be the client, grilling me about my presentation, saying, "Well, everybody knows that the video game market is all about tie ratios." I don't even remember what a tie ratio is. I guess it's something about tying your console sales to your game sales. Anyway, I don't know anything about that, so uh, can't help you much there. And I've never seen a question from Patrick Chatin before, so can't help you much on that one either. I did my wild speculation yesterday, or maybe by the time I put this up 2 days ago, on what Michael's beer case might look like on the beer data. But then there's also a second part of his, which is just a financial model. I don't really know anything about what that's going to be like, but as usual, I'm looking at what's a past case by Michael, and maybe we'll get some kind of a sense of his form. Now, for a person who records videos as often as I do, which at this point is like several times a week, you would think I would have learned not to record a video without plugging in my headset first. But that is exactly what I did earlier today. So I've already built a model for this question, spent quite a lot of time on it because I didn't do a great job of it, and that video has no sound. So instead of building this from scratch again, because I can't bear to do it again, I'm just going to kind of walk you through my model and my thought process, and frankly, that'll be a lot faster than watching me build it anyway. I'm sure some of you would prefer if I just did it that way all the time. Not sure if I'm willing to do that because then I'd have to prepare everything much more, but maybe I'll think about it sometimes. Anyway, if you prefer that format, let me know. I'm going to dive on in. So, what is the question? Let's flip over. So it's about tax. You're considering building a solar farm in the imaginatively named Modelandia. There are 6 different states, all of which with different weather, so obviously different sunniness, different productivity of a solar plant, and also different tax treatments. So first you model solar farm kind of operations in the cloudy but tax-free state of Affordaville. In other words, just get it working without tax. And then part 2, you go through various different permutations of the tax rules. So that's all fine. That's all fine. That's all fine. Okay. So build a quarterly model. Fine. Don't need to construct a full set of financial statements. It might help you. All relevant dates are in the model. Construction starts at the start of 2023 for 3 years. Operations start at the start of 2026 for 20 years. So well, let's just go through the rest of the preamble. All cash flows occur at the end of a quarter except the debt arrangement fee and the initial capex payment. That's a very important thing if you want to get your IRR right. And there's inflation of 3% per year, stepping up at the 1st of every January. Starting costs are January 2023 prices, so the first step up is January 2024. So as soon as I got through this bit and before I went any further, I flipped over to my model and started building the basics. And by the basics, I mean basically everything down as far as here. So first thing, I have a start date here, which is financial close. So I did e-date from that. 92, which is 20 years of operations plus 3 years of construction, is 23 times 4 quarters per year because we want a quarterly model. So there's 92 periods in the model. I put a general counter across the top here as well, 1 to 92. So then e-date from there, 92, starting at 0 in steps of 3. In other words, first offset by 0 months, then by 3, then by 6, then by 9, then by 12, and so on along until you've done 92 periods. And then for each one of those, EO month, in other words, the end of the month 2 months later. So from January we go to the end of March, from April we go to the end of June, and so on. So this is my quarter end, but I also made it my cash flow date, and I added one other option here, which is financial close, and I just put the cash flow date there as the 1st of January. So basically I can use this line as my date input for an IRR function. Then I have a construction flag here, so the first 3 years, and then the rest of the time is operations. And then I also calculate the quarter in year, so Q1, Q2, Q3, Q4. And then I did inflation, just a hard-coded 1 to start, and then if you're in month 1 or if you're in quarter 1, whatever way you want to look at it, then up by 3%. You'll see I hard-coded this. I hard-coded a bunch of things in this because part of what I was practicing with this is I'm trying to get out of some of my good habits, like good habits in real life of not hard-coding anything, linking everything, because it's just not fast enough. I'm trying to get faster. So I just typed in the number. Terrible practice. Don't ever do it in the real world. But in an FMWC round, sure, why not? So that's that. Then let's go back. Revenue generation. Each state will have a different initial generation amount per quarter. So you'll see that basically there's 6 states here. There's different generation amounts per quarter, and there's various different other assumptions underneath each of them. So the next thing that I did was add a selector for active state, and let's just start off with it in a affordable as it's supposed to be, and then added a 7th column here. So there's these 6 columns, and then I just put a 7th column for active, and I just did one XLOOKUP to keep it quick, XLOOKUP the active state in this table, return this entire block. Now, I'm being lazy by doing just one big XLOOKUP because that puts in zeros here where it's not really pretty to have them. I was also lazy with the formatting. I just copied the formatting from the next column and brought it over, which meant that, it's fine when you're on a Fordville, but if I flip over to Common Land, for example, these things are not formatted as assumptions. But none of that matters because competition. I would tidy this up if it was a client model, but it's not. So that's that. So here's the generation in megawatt hours per quarter for each location. So back to the revenue assumptions, and it says due to seasonal effects, these amounts vary throughout the year, so different for each quarter. But assume they remain fixed over time, i.e. Q1 22 is the same as Q1 23 from a sunniness perspective, but you do have degradation, which is discussed down here. All energy is sold at the time it's produced at the market price, which is the same across each state, and we're just given one fixed number, $100 per megawatt hour, which that's again the January 2023 price, so that has to inflate. And regardless of location, the solar farm will degrade at 0.25% at the end of each quarter, starting from the beginning of Q1 in operations. So in other words, 2026 Q1, the first quarter of operations, will have 99.75% output. Then the second quarter will have 99.5006% output. And the reason that's not 99.5 flat is because you're not subtracting 0.25%, you're multiplying by 1 minus 0.25%, or in other words, multiplying by 99.75%. This degradation is geometric, which, yeah, I guess that's another way of saying that. So 2026 Q3 will be 1 minus 0.25% to the power of 3, rather than 99.25. Okay, so that's explaining exactly what I just said. So the next thing I did was come over here and calculate a degradation index. Again, super sloppy. I just hard-coded zeros throughout the construction period. Not a flexible way to build it, but but before being quite this rigid about things, it's worth scanning through the questions just to see, are you going to need to change the degradation index? Are you going to need to consider a scenario where the construction is accelerated or whatever? But in this case, you're not. So again, wow, I'm being really bad here. I didn't even make this a different color when I'm entering a number and not a formula. Terrible. Anyway, and so for the rest of them, I just multiply. You see there's a dollar on here. So this one points to the previous period, and this one points to always back here. So multiply by 99.75%. So in other words, here, here, and here, you're always just multiplying the immediately previous one by that constant term. And again, I didn't even link this to the assumptions. There is a 0.25% in here somewhere. Somewhere here. But I didn't link that because, again, just trying to be faster. Then the maintenance period, I totally shamelessly hard-coded. I just typed in zeros for all of these. Sorry, I haven't read the maintenance period assumptions yet. We'll come back to the operating cost in a second. So in 2036, the solar farm will be switched off for 9 months for maintenance. No degradation occurs during that period. At the end of the maintenance period, it's 5% more efficient than whatever it was before the maintenance period. So again, I just zeroed it out for the maintenance period because I figured we'd be multiplying the production by the degradation. So if I zero it out, that's the equivalent of turning it off. I don't even need a maintenance period mask. And then here I just put a different formula, that times 1.05, and then carry back on the same as before. Assume no additional costs are due during this period. Maintenance costs are covered by managed service agreement, fine. And this was actually a little whoops. It said in the bonus question, you will move the maintenance period. You may wish to consider this when building your model, but I think that bonus question got taken out because it was too hard, which is part of why I hard-coded this, because I remembered that vaguely. I did set it up dynamically at the time, and that was a waste of time. Anyway, so, all right, so then we have everything we need for revenues. So we just do, here's the generation pre-degradation, which is just a straight index. So we're going to index, so if we're multiplying by the operations flag, so it gets zeroed out pre-operations, and then in the operations period, that's just multiplying by 1, so it leaves it alone, and we index in here by the quarter number. So super simple. Then with degradation, you just multiply that by the degradation index, and then the revenue is just the production with degradation times the $100 per megawatt hour times the inflation index. Super simple. Then we have fixed costs and variable costs, which is here. Solar farm has fixed costs and variable costs, which are a function of how much energy is generated. Simple. So you got $50,000 per quarter fixed, and again, you just need to inflate that. So operations period times inflation index times that cell, which is $50,000. Simple. And then the variable cost is your generation times the inflation index times the dollars per megawatt hour. So simple. So there's your project cash flows before debt. You just add up the revenue and the two kinds of direct operating costs. Then I came back to all this bit later after I had done some other stuff down here. So before we get into all the stuff for tax, we have to do the financing and the construction costs. So let's read about that quickly. So we've done that. No taxes in Affordaville. You may want to leave space in your model for them. Very sensible. So construction costs and financing. Cost curve is given in your model. So that's here. Slightly different costs in each location. Oops. And this is the percent of the cost split, and then just multiply that. So again, we just pull that in for the active one, and then the way I did this, I just did a straight transpose of that and left the rest of the row blank. You might prefer to do, like to replace these with dates, and then do a lookup, but this works just fine. And important to note that the first one is at financial close and then the first quarter, and that lines up to the way I've set this up. So I've got financial close as a separate column and then first quarter. So that's the construction curve. Should not be subject to inflation. Good. 80% of construction costs covered by senior debt. So here's debt financing right here. Again, I just hard-coded. Terrible practice. Don't ever do it unless you might get done a little faster in a competition. I can't emphasize enough. The nature of a competition is that you will never have to revisit this model again. And if you're ever building a model in the real world that you think you'll never have to revisit again, you're probably wrong. Build it better. Okay. So 80% covered by senior debt, 3% per annum, 3360, so each quarter is just 0.75% interest. Arrangement fee of $1 million payable at financial close. And now we've got the two terms here, the construction cost and the arrangement fee are the two things that we were told were the exceptions to, where is it? Yeah. Assume all cash flows occur at the end of the quarter with the exception, and when I have this this page printed out, I would like underline these exceptions and make sure that I revisit them. So the exception of the debt arrangement fee and the initial capex payment. So these are the only two cash flows that happen at financial close. Everything else is in a normal quarter. So where are we? That's the arrangement fee. All financing costs during construction should be rolled up into the balance of the debt. So in other words, the drawdown that we make at financial close is the debt financing, 80% of the construction, plus the $1 million arrangement fee. Capitalized interest is just the interest multiplied by are we in the construction period. So you capitalize in the construction period and then you stop capitalizing. And then it's just the usual repayment we come to later. Again, terrible practice, but I've just left this blank during the construction period and then filled it in later. And then your interest is down here. There's a lot of additional complexities that I've added on here and in various other places to reflect kind of nuances of the variations in the different states. But the core formula here for the interest, for example, is just the opening balance times the interest rate divided by 4. Then there's an adjustment if you're in state F. And the repayment, again, the core piece of the formula here is PPMT. So the interest rate divided by 4. What period number you're in is just the sum of the construction, the operations period so far. So again, I've just locked one side of that reference $R. The other side grows, so that'll tell you which operations period you're in. The total number of periods, it pays off over the 20 years of operations, so 20 years times 4 quarters is 80 periods. And the PV, again, you just start with the loan value as it is at the end of the construction period, because that's when you've stopped drawing. So I've just locked this in as a cell reference here. So many things that would be extremely hard to change if I had to like flex the construction period or anything like that. So, you know, use with great caution. But anyway. So then we get our project cash flow with debt, which is our project cash flow before debt, less our principal repayment and interest repayment if we're in the operations period. Otherwise, well, this is blank anyway, but this is not a cash flow because it's getting capitalized if we're still in construction period. And then we have our equity cash flows. So the construction draw, which is just the total construction cost minus what's debt financed. The operations draw slash cash flow injection. So in other words, what do you get out of it? The net cash flow all comes, well, sorry, let's read the assumptions so we can see that. Where's the equity assumptions? I missed them. Oh, sorry, here we are. Yeah. All remaining cash flows to equity immediately. So that 20% of the construction costs are financed by shareholder equity. No senior financing costs should be covered by equity, only construction costs. And all remaining cash flows to equity immediately. In the maintenance period, cash flows can be negative. In these periods, the shareholders will contribute cash to the company to make up for the cash shortfall. So you can think of this as, you know, if cash flow is negative, then injection, otherwise yada yada. But actually all it's saying is whatever change in cash happens, that goes directly to the shareholders. So in other words, if there's positive cash, it's a dividend. If there's negative cash, it's an injection. So you could split this out into separate lines, but there's actually no need to. So here you start getting injections, and then whenever we get to the maintenance period, 2036, then you have to pay back in. And then we add a line for the tax payment, even though there aren't any tax payments yet. Then we get total cash flow and IRR. All lovely. So that's basically part 1. And then part 2 is all the fun of taxes. So now you have your basic model working, time to do tax calculations. Your generation amount and capex profile will differ from model to model. A couple of states also make slight changes to the financing terms of the debt. Fun. So in all states, depreciation for tax is the same as book or accounting. Fine. And this part's important. The construction cost and interest and fees during construction all get capitalized into an asset. No depreciation during construction, and then it depreciates straight line over 20 years. So again, not claiming any best practice here. In fact, I'm actively denying that this is good practice at all, but we sum up the arrangement fee, the construction costs, and the interest in the construction period. That's our asset, and then we just minus that divided by 20 divided by 4, straight line over 20 years, 4 quarters a year. So that's the depreciation. All interest and fees during construction are capitalized, so no profit or loss occurs in the construction period, no taxes payable, no losses are made. Makes sense? Taxable profit is calculated as revenue minus costs, tax depreciation, and interest. So in other words, depreciation and interest are tax shields. Makes sense. So starting from our project cash flow x debt, we subtract off depreciation and interest, and we get to our taxable income. So the interest is just, again, deductible is a little bit different. We'll come back to that, but for now, we're just pointing at the interest. And then that adds up to our taxable income. Pre-loss offset. So then there's also loss offsetting rules. Tax is then just the taxable profit multiplied. Unless told otherwise, tax is paid quarterly. If taxable loss is made, this is the important part. The tax loss can be carried forward to be used to offset profits in future periods. No restriction, and taken as soon as possible unless you're told otherwise. unused at the end of the project just remain unused and nothing happens. So then we need a simple tax loss pool. So in other words, here, for example, we make a loss of 234,000. So we carry that forward. We offset it against 169,000 of this. So we have effectively no taxable income here. So to manage that, we just have a simple tax loss pool. You could actually do it a little more simply than this, but one of the jurisdictions requires some tax losses to expire. So it's better to keep the full bells and whistles option. So we start off at 0. Opening balance is the previous period's closing. If we make a loss, then we add that to our loss pool. If we make a profit, then we subtract that from our loss pool up to a max of how much profit we made. And again, in some jurisdictions, there's a percentage limit on how much of our profit we can deduct. And then expiry. There's no way to help this formula being a little bit complicated, I think, but the idea is just, let me come back to that one when we come to the one where it expires. So just for now, expiry is 0, closing balance, and then whatever you used up there, you take away from your taxable income, and then you calculate your tax on that, which right now is NA because there's no tax in a 40ville. So let's go to basic here instead, so that there is tax, and then you see. Now you don't make a loss in the first quarter of operations in basic here because it's also sunnier, but that's fine. So let's see, yeah, you make a loss here in I guess a darker quarter, and you can use that to offset the profit you make here and some of the profit you make here, and then you're back to fully charging and so on. Okay, so basic here doesn't have any additional rules. Common land has a couple of adjustments. So carried forward tax loss may only be used to offset 25% of the profits in a future period. So there's an assumption somewhere here, percent of profits to offset with losses. So basically, I pull that in here, M35. And then over here, I say, where you're figuring out the limit of how much you can use, first try multiplying your taxable income by the percent that you can take off. In other words, you can take off 25% of that if you're in common land. Let's just flip to common land so we can actually see it. So here you take off 25% of that. If this number is NA, in other words, if you're in any scenario other than common land, then you just take the full taxable income. Then you take the max of that and 0. So in other words, you don't use anything up from the tax pool if you make a loss, and then you take the min of that and what you have available to use in the tax pool. So that's how you limit the deduction. And then in addition, tax losses expire if they're unused for more than 3 years. The only place that actually happens, because you're pretty profitable here, is the maintenance period. So here, you're adding a ton to your tax loss pool. The amount that you use up over the next few years is less than that. So just at the end, some expires. So what's the logic for this? The idea is you add up everything that you added to your tax loss pool at least 3 years ago, and then you take away everything that you've used up to this period and everything that you've expired up to this period. And if that's still positive, then that has to expire now. So hence max of that and 0 to say if that's still positive, and then you subtract that off if there is something there. So there's only one period where anything expires. The model off tax video I did a little while ago, I talk a little bit more in detail about the logic for this tax loss expiry, but that's the idea. Okay, so let's go on deductbill. There are restrictions on the deductibility of interest. Interest can only be used up to 35% of EBITDA. However, if some interest is disallowed, as it's too high relative to EBITDA, then it can be carried forward without restriction to a future period where EBITDA is higher, and if EBITDA is negative, it should be treated as 0. So let's flip to deductbill. And we have here the 35% that can be used, and so I just made a little interest deduction pool. Oh yeah, see, look, I did it again. I hard-coded because I'm terrible. All right, so what's going on here? Again, as usual, starts off 0 at the end of the construction period, carry over the previous closing, then you add to that whatever interest you have in this period, so that and then you use whatever interest you're allowed to use. And what is that? That is the smaller of. So first it said treat negative EBITDA as 0. So you take the max of the EBITDA and 0, take 35% of that. That's your limit. And then it's the smaller of that and the interest you have available to use, which is whatever you carried over plus whatever you added in this period. That's what you're able to use. And then your closing balance is that, and you carry everything across. And then up here in the interest column, I just said if the active scenario is deductible, then take the number from here, otherwise take the interest. And that's all it kind of takes to plug that in. So we move on. Extra town. Rules for extra town. Tax is annualized and not paid until the end of the calendar year, and it has a sliding tax scale. Infrequent extra nature of tax payments means there will need to be equity injections to cover the tax payments as they're not smooth. Don't worry about this. This is okay. Okay, so tax rate is 12% on the first 500,000, and actually I remember this at the time. There's actually a break between the model and the text. It's supposed to be 11%. Luckily, I linked to here when I was working on it. So 11% on the first 500,000, 15% on the next million, and 20% on everything above 1.5 million. So how do we do that? So first things first, our taxable income pre-loss, we add that up at the end of each year. This is the total taxable income pre-loss, and I just put NAs in these three so that I could copy that whole block and paste it across. And then you look at, main thing is you look at here, you've got 1 year where you make a loss, but only one, the year of the maintenance period. Every other year across the cycle of the year, you're positive. So I just did the loss carryover as a total manual fudge. So I just, where thought I'd done it there. That's strange. I don't seem to have done it. Don't know. Getting distracted by this now. Anyway, so the idea is you figure out the total annual taxable income. I didn't even label this line. Look, God, I'm being so sloppy. So what is the tax on that? Again, it might be certainly better in a client model, might be better in even in the competition, depending on your level of comfort with this, to break this out into more cells, but this is how I did it. So the smaller of the taxable income and this first input, which is 500,000, sorry, whoops, that's the 500,000. The smaller of those two is your taxable income up to $500,000. You multiply that by the first tax rate, which is the 11%. Then you take your taxable income minus the first 500,000, and you take the median of that and 1,000,000 and 0. In other words, if you're less than 500,000, take 0. If you're more than 1.5 million, you take 1,000,000, because that's what you have between 500 and 1,000,000. Sorry, between 500 and 1.5 million. And otherwise, you take whatever's in between. And you multiply that by the second tax rate, which is whatever the 15%, yep, 0.15. And then take the max of your taxable income minus the 500,000 minus the 1,000,000, max of that and 0, and multiply that by the top rate. And then I just, like I said, I kind of manually fudged the tax, or the loss carryover piece. I just put in a 0 here because there was only 1 year with losses and it wasn't worth thinking through it anymore. And then I just had this tax payment line that just said if the active selection is extra town. I guess at some point along the way I named it. Some of the earlier formulas I just had a cell reference. Then I just used n of this to say ignore the text and only take the numbers. And if you're not extra town, then your tax line is from here. And then there was one more, which is kind of complicated. The rules for foreign local lenders are less willing to lend to a project here, which means they have to find a foreign lender, and that has two impacts. One, the interest rate will go up at some point along the way, and so you'll have to figure out your mortgage payment. You won't be able to use the PPMT function. And two, there's a withholding tax on all foreign debt at a rate of 10%. So on top of any interest payments or arrangement fees, the lender will have to pay an extra 10% tax to Modellandia. Principal payment is not subject to withholding tax, so you'll have to adjust your interest and arrangement fees. So how do we do that? Relatively simple, really. So let's just activate Forgant so we can see that. Oh, that's why my extra down thing was looking funny, was because I had not activated extra down. Okay, so now that makes a little bit more sense. Anyway, so let's activate Forgant. And so here we're saying, you know, you've got to pay 1111111 if, you know, 10% of that is being taken away. So in other words, that minus the 10%, the 90% of that is what you have available to pay the fee. So for a 1 million fee with a 10% withholding tax in this way, you have to pay not 1 million plus 10%, but 1 million divided by 90%. So that's what's going on there. And the same thing going on with the interest. If we're in Forgant, then we divide by 90%. And again, I just did a total hack here. You can see just from the 1st of January 2029 onward, I just have a different formula, which is I can't tell you how bad a thing that is to do in the real world. Don't do it in the real world. But, well, I'm not going to keep saying it. You get the idea. So if we're Forgant, then we have this new number, otherwise the old number. And if we're Forgant, then we divide by 90%. And then the last thing was the payment. Like I said, you can't use the PPMT function. There is a way, if you want to read about it, take a look at which video is one of my model off videos. The one on precise debt modeling talks about how to size a mortgage payment in the presence of either variable interest rates or periods of variable length, which I actually did on the day, but again, trying to just get on with things, not do things the proper way for the purposes of this. So what did I do? I said, if it's Forgant, take this, take the interest and subtract off the fixed amount to get the principal reduction. And then I just came over here, took this and said Alt-TG to 0 by changing the fixed payment cell. Crude, horrible, offensive, but it totally works. And that's it. Oh yeah, and then sorry, the last couple of questions asked about comparing the IRR across the different options. So I just came over here because this is where my active state assumption cell was, and I built a data table. So I linked this to the IRR. That's the 15.9% there. Then I list out my site names, and then you just go Alt-DT. Column input cell is the selector, and this basically says what value does this become if I put Affordaville in here, if I put Basicia in here, if I put Common Land in here, if I put Deductiville in here, if I put Extra Town in here, if I put Forgant in here. And that tells me all these different answers. And so there were two questions. One was to sort the states from highest to lowest IRR and list the letters. So I just did that by, I said sort the first letter of that range by the range of IRRs in descending order, and then concat them together. And then the last question just asked what was the highest IRR you could achieve in any state, which was that one. And that's it. Wow, even just talking through it took more than half an hour. This was just a big, hairy, complicated question. But still, that's only half as long-ish as it took me to build it. So I've saved you some time. You're welcome. If you're competing this weekend, good luck. And yeah, I don't know. I'll hopefully post at least some of my live attempt on Tuesday once the round is over for everyone. Thanks for watching. See you next time.